today's educational webinar. We're calling it an educational webinar because it's exactly what it is. So thank you so much. A very good evening to everyone who's joined us. If you are from the East Coast, a special good evening to you because it's 9 o'clock your time. And thank you so much for doing it in the middle of the week. I'm Shiv Jayaraman. For those of you who have joined previous webinars, I moderate these webinars as and when Eng feels it would be a good fit. I am an investor, a very active investor with Josie Capital. I do not hold any position at Josie Capital, although after knowing Eng for close to a year now, I am seriously thinking about giving up my other commitments and taking a more active role in Josie Capital, but I'm as active as I can be as an investor with Josie Capital. So I'll be moderating today's webinar. Before I hand it off to Eng, a couple of requests from everyone. If you have any questions at any point of time during today's webinar, please ask those questions in the Q&A box and not the chat box. The chat box is alive right now with a whole bunch of CPA recommendations, which is good, but ask your questions in the Q&A box. That's one. Second, we're going to be talking about real estate asset classes. It's a very wide topic. So if you're new to this, here is my recommendation. How did I start off 3 years back when somebody like Eng would present to me? Do not get caught with the gory details. If Eng is talking about some specifics, do not get caught in that. Try to understand the 10,000 feet or 20,000 feet level understanding of this asset class. And later, when you're one-on-one with Eng or anybody at Josie Capital, maybe Ryan, ask those specific questions. Try to focus on the generics and the overall comparisons and contrasts between the asset classes. That's what I found very useful. So please ask your questions in the Q&A box at any time, and I'll moderate by floating in the questions. With that, I'll hand it off to Eng. Good evening, Eng. Thank you so much for your time. Take it away from here.
Thanks, Jeff, for the introductions and helping moderate this educational webinar. I'm going to be presenting on real estate asset classes, and I want to preface saying that this is not a research report of someone who's been is an analyst in a commercial real estate investment company. It's my personal experience. It's also, finding what I've known and what I've looked at when I've been trying to invest in these type of asset classes. So I wanted to just preface that. And so without further ado, I will start the presentation and I'll introduce myself in a bit. So I want to, first, it's going to be quite a lot of information, but I want everybody to feel free to interject, ask questions. Shiv will interject for you guys on your behalf. We'll talk about asset classes, comparing residential and commercial, and then comparing the asset classes across a few KPIs. And then go into my experience with investing in commercial real estate. It seems like a daunting task, how to invest in that. And if we have time, although I don't know real time, go into market forecast for this 2021 after after the pandemic or recovering from the pandemic. So my name is Eng Tang. I am CEO founder of Josie Capital. Thank you for joining me tonight. My background is in economics and finance, but I have a wide variety of experiences, including being an investment banker, a Peace Corps volunteer, leading analytics, being an iPhone team, Apple Music, product manager, and leading data science in Siri. I've also been an investor since 2009 and been investing in real estate in all these roles. And I've been investing in a myriad of real estate. And to this day, I've been able to accumulate $140 million of assets under management. A little bit about my history of real estate investing. I bought my first rental property in Triplex, fondly remember that one, when I was 12 years ago in 2009, bought out of state property. And so I've also very familiar with investing in out of state and what it takes to invest in out of state. And I've been buying triplex and rental properties, residentials for a while in California and learned pretty quickly that this does not scale. And so that I'll interject that throughout the whole presentation, talking about scaling and how that, how at least I perceive it. Now, not everybody's trying to scale, so of course, take that for what it is. And I'm leading and investing in multifamily, retail, shopping centers, mixed use industrial, office, senior living communities, and opportunity zones. So I have a wide experience. There are a lot of differences, but there are a lot of similarities between these asset classes. So I want to get into discussing these in categories first, in what I classify as residential and commercial. But when I think about residential and commercial, I think about it from a lending perspective. So residential loans are definitely, when you look at residential loans, it's single family to fourplex. And that's what most people are investing in, what that feels most accessible. It's very familiar. If you're living in California or Seattle, it might not be the most viable thing right now in terms of rental income, but it leverages your finances. Residential housing investments leverage your finances. And if you have a great W-2 income, this is a great way to invest because it leverages that. However, it doesn't scale, and the variable costs can be a little bit higher than some of the commercial equivalents. Purchasing and maintenance can be difficult. Scaling is something that I think about a lot, but might not be something you guys think about. For me, buying a 100-unit multifamily takes almost around the same time as it does buying a 3-unit triplex, because of the dependency on the people involved in the process. And so with commercial, I think about it as cash flow investing. That's how I've always invested in commercial. Residential, I think of it more of as an appreciation play, buying equities and stocks, highly tied to affordability, of course. Commercial, which includes, from my definition, residential multifamily. Commercial is typically seen as 5 units and above. That's what the banks consider commercial versus a residential loan. There are rate differences between the two. But also includes retail, office, industrial, self-storage, mobile home parks, etc. In my experience, financing can be easier with commercial. Commercial lending is folks who are very professional, who want to provide big loans, but want to provide them on the asset itself, meaning that they're not leveraging your finance. I, as somebody who doesn't have a W-2 job right now, can get a multi-million-dollar commercial loan on a property that pays for itself. And for the most part, we're buying real estate in commercial land. That's essentially what the banks or financing looks at. Can it pay for itself and then some? And then one of the biggest difference with commercial and residential is that you have more control on valuation. So what does that mean? That means that when you have a single family house, your neighbor's single family house sale dictates what your price or your valuation is. It doesn't matter if his house is worse off, is making less money, or is making a lot more money. But when it comes to commercial, like multifamily, large scale multifamily, it really depends on the NOI of the property. Two similar properties next to each other in the same geographic location could have 2x the difference in NOI. That generates a nearly 2x difference in valuation, because NOI drives valuation, which is a part of cap rates. Cap rate is NOI, net operating income, divided by purchase price. How much are you making on the property unlevered? And typically for commercial, there's a range. We'll talk about that a little bit. But the more you can coax out of more income you can coax out of a property, more income you can generate from a property by reducing expenses, increasing revenue, the more you can control the valuation. Now, for residential, there is some benefit of not having that control of valuation. For the stock market, you have very little control of the valuation of what the stock market is at any given time. It's much more about market sentiment and what the next person would buy and sell. And residential is a much more tradable asset. People buy and sell it all the time, mostly to actually live in, some to invest in. But that helps with a higher potential increase in price, especially when the markets are booming. Of course, it also hurts when the markets are going down. It's a much more volatile asset class than commercial. So I want to talk about asset classes in three categories. What I call first.
Yes. Just a quick interruption. I do know that people want to pay attention to the webinar. So you don't have to take notes. You don't have to take screenshots of the slides. The recording of the webinar will be shared. So take it easy. Just focus on Eng's narrative. Just wanted to send that to the investors. Go for it, Eng.
Thanks, Jeff. I'm going to talk about commercial properties and not the whole spectrum of commercial or real estate properties in three types. One, residential needs. When I talk about residential needs, you got to talk about single family, and we'll talk about single family and why some of the challenges of single family investing, at least from my perspective. It typically has little cash flow. If you're in California, it has negative cash flow. It has unforeseen capital expenditures that can wipe away years of cash flow and tank returns. Most people aren't evaluating what potential occupancy is, what a capex would be, because it's very volatile. Occupancy is binary, 100% or 0%. It's high volatility of outcomes, which has, if you have 100 single family houses, that works. But if you have a 100-unit multifamily, that sort of has the same scaling and reduction of volatility effect. So there are no economies of scale, extremely hands-on, although that's mostly because it has no economies of scale. You're going to have a lot of work having four single family versus a fourplex. And most of the competition is not seeking to acquire an investment, but a place to call home, which has some positives as it can create a rising price of single family that doesn't seem to be correlated to the investment or how much it yields. So it can be an irrational market. And sometimes you want to be in irrational markets if you want to ride a wave, if you believe in that strategy. That's not something I would, but that is something that if you're investing in Austin last year or this year, potentially that could be a good strategy. But these are some of the challenges with single family houses and why I have typically not moved away from it. Personally, also, in some cases, banks will limit you to 5 mortgages. And as a whole, it could limit you to 10. There are ways to get around it, but those could be some of the limitations. Of course, if you're looking at single family and saying, I'm not going to buy more than 10, then, maybe I think it's definitely a good entry investment, although there are other ways to potentially get the same entry with the same investment amount. So multifamily, some of the hottest assets in commercial land, and probably the most talked about, has comparative to the other commercial properties I'll talk about, has very low interest rates and mostly non-recourse. Non-recourse means if the project defaults in some way, if you default on the loan and certain parameters are met, meaning that you aren't doing it explicitly, it could be a non-recourse loan. Mostly multifamily provides that leeway. Non-recourse means that it doesn't impact your other investments. It doesn't go after your other assets. When you default on a single family house, that is all recourse. Residential loans are almost always recourse. In fact, I don't know a non-recourse residential loan. So I believe it's all recourse, and non-recourse, which is very standard in mostly larger commercial buildings, both multifamily and other commercial, but especially in multifamily. And so one of the things that I think about when you invest in something, you always think about, is it tradable? What that means for me is, would somebody buy it very easily? That also means that it's going to be very competitive to buy. So there's pros and cons here. When you have a very competitive asset class like multifamily, the cap rates compress, which means that you get lower yield on your money over now versus last year. It's increased significantly. But it also means it's very tradable, so that it's not a very risky proposition. It might not be a high yield proposition. So those two effects usually balance each other out. One thing of note is that DSCR is something that in us real estate investors think about a lot, and DSCR is debt service coverage ratio. that is a factor of basically how much you owe on your debt to how much income you make, NOI, in the property. And so for most multifamily, most lending, it could be typically 1.25. In some cases, is a little bit less. Sometimes a little bit more. Depends on the market. Depends on the class of the asset. But that means that that most lenders are looking for the project to make 1.25 times more than the debt. And for real estate in general, you don't really have any issues with it as long as you pay your debt. So you don't have to have any selling pressures or buying pressures either way. One thing I really like about multifamily and renting in general, and real estate in general, is that the overall long-term trend is that people will become renters. Every financial crisis generates more income disparity, which is terrible, but it makes more of us a renter nation. Millennials and younger generation, it's going to be much harder for them to afford housing when their income growth hasn't been as much as asset growth or multifamily or housing growth. So in some cases, this overall trend is going to generate a lot of more customers and demand. And you should think about every one of these assets. Who are the customers? Is this a customer that will be growing, a clientele that will be growing? And is it, what impacts do the current pandemic or any other economic factors have on that customer base? Because that's generally going to create how much money you can make, how much income you can make, and which will dictate the price and valuation of these properties. So renter nation is definitely a trend from a financial perspective. But another thing here is that younger generation also want flexibility. I mean, who wants to own a car nowadays when you can have Uber and Lyft? Who wants to be stuck in a 30-year mortgage when you can rent Airbnb and rent a multifamily and try different locations? The world's more mobile now. So I think that's another trend that we will see in long term as well. Agency loans also is another big factor of multifamily. And I'm going to talk about multifamily a lot, but the other ones I'll talk a little less. Agency loans are essentially government loans, Fannie and Freddie, and they have some of the best rates. So it's something that as you go into commercial or any other kind of classes, multifamily has some of the best backing. Essentially, is the government saying, I really like this asset class. I'm going to give you really low rates to encourage investment, as well as I believe that it's very tradable. The default rates of multifamily in the last financial crisis was less than 1%. The default rates of single family in some geographic regions were as high as 30% in Arizona and Florida. So this volatility happens because of cash flow and affordability. Multifamily generally has some of the best affordability. So another residential need, and something that maybe some people might not think as residential need, but it's a consumer need, self-storage. It's high demand and has typically long tenure. Most people actually would rather leave their apartments than take this junk out, the stuff out of their self-storage. And the average tenure of self-storage is typically 1.8 or 2x longer than multifamily. So you're staying at it nearly 2 to 3 years. And then like you all of a sudden remember, oh shit, I'm paying $90 a month for my self-storage. What did I leave in there? And then you have one of those reality shows. I think those are fake, but it's also very low maintenance. And as somebody who has explored solar installations on a lot of different asset classes, it's actually ideal for solar, although it doesn't generally need that much electricity. But in a sense, most other asset classes, you're actually passing electric costs to the tenant. So it's not actually ideal to make the costs lower because you're not really getting any benefit unless you negotiate in the lease. So solar installation for something that you're not necessarily passing electric costs on might be a good investment. And in the case of the pandemic, a lot of people are moving, and a lot of people are moving just temporarily. That's seeing a need for self-storage as they move to different places, to homes, to parents' places. So it's one of the hottest asset classes. Is the cap rates are kind of compressed. There's lots of new supply coming in, potentially putting pressure on rents and occupancy. But it's very low maintenance, especially if you get a third-party management company like Extra Space or Self-Storage or something like that.
Very quick interjection, and to all the investors who are on the call, if you have questions, please do help me out by asking them in the Q&A, using the Q&A button and not on the chat. That way we could track the questions more easily. But whoever is asked on the chat box, I'll make sure they are taken care of it. And there's a quick question on storage, right? So maybe your thoughts would be welcome. An investor says, there's this minimalist movement going along, less is better, where people own less in the future. Do you think that's the way it's going to be? If so, what will be the demand for storage?
I think there's a minimalist movement in housing, which means that there's less space and you need more storage as well. So that's something that you were observing, on the average 3 bedrooms is smaller than the average 3 bedroom about 30 years ago. That more people are having less stuff, I believe, but there's also more people in general. So those two factors, what we've seen with self-storage is a very strong trend. There's lots of trends across real estate classes that have strong trends. It's just the fact that there's just more people, more demand for things. And these asset classes are fairly resilient, and even some of the other ones that seems a little bit more fragile. Farshad asks, is there property tax differences among these classes? I'm not a property tax expert. I do not believe so.
Whenever there is comparing and contrasting between different classes, I thought we'll wait till we introduce all the classes so that people can appreciate the question. So don't worry about it, and just go with your flow. I'll make sure the questions are taken up.
Mm-hmm. Yeah, and I have a pretty deep audience of people who have invested and managed self-storage. So hopefully I'm doing you guys justice. Student housing. So another residential needs type of asset class. And I think it's sort of a niche of multifamily. In fact, a lot of these asset classes could be essentially a niche of multifamily. So rent and occupancy is very tied to student enrollment, obviously. Pre-leasing for upcoming fall term is down 4% year over year as of January. But what we're seeing is also some steady momentum in growth. And I think one of the things that you should watch out for when you're investing in student housing is that it has higher turnover and wear and tear. So a little bit, it's going to be very much more dependent on, a good property manager to manage it. It does have higher potential rent. Every time you have something that takes a little bit more operations, a little bit more turnover, you can usually charge higher rent for a similar price per square foot than regular multifamily.
And then if I might add my experience on student housing, if you have very good universities, many of these universities also have postgraduate student housing. These are typically PhD students. Some of these parameters might be more enticing for you. People are not going to burn the rooms every 3 days. So you have various kinds of student housing, but generally whatever Eng says is absolutely correct.
Yeah, PhD. I mean, it's a wide variety. 4-year degrees in community college is slightly different, and student housing isn't necessarily always. It's really you're dictated by location and proximity. So there's obviously limitations on where you can build student housing and availability. Mobile home parks, another asset class that I have a little bit less familiarity with, but as I've looked into mobile home parks myself, my take on it is that it's low maintenance, low costs, because you typically have lots that you rent to mobile homes on. So you're charging a rent fee instead of just renting out the building. And when somebody owns the building, in this case, the mobile home, they actually take care of it better than you because they have a lot more incentive. They repair it. All that repairs is on them. And mobile home communities have very low turnover, one of the lowest turnovers of any community type. There's less competition as there aren't a lot of places zoned for mobile home parks. So that's another, mobile home parks are potentially good investment, but there's generally less of them. It's not something that has been widely zoned more recently as um, you know as we shift from mobile home parks, as there has been that mobile parks was really popular several decades ago and became less popular. There are tiny home villages that are coming online. One of note is in Austin, and I'm exploring some of these things, but it could be a similar type of style of mobile home parks where essentially, the big facet here is you own land, you rent out the land, the mobile home park or a tiny home rents out it for a lease, and you have very little building costs, maintenance costs. But infrastructure can be owed because some of these mobile home parks are relatively old because they just have been building new ones or zoning new ones. It can be difficult to evict tenants that own trailers and just rent the land. So those are the residential needs categories, not covering every one of them. And I'm going to highlight now a second asset type or category, commercial contracts. And they have a lot of similarities. I'm not going to go to every bullet point here. Industrial is one of them. Industrial have generally longer tenancy, lower expenses, and oftentimes in triple net. Triple net means the three ends of the tenant covers the insurance, property taxes, and maintenance. In some cases, even the property management fee. Vacancies are longer. And I'm going to be saying these things, and it'll be applied to the next two assets in this category. Long vacancies can be bigger because if you have a big asset or a big lot, it's going to have a little bit smaller market for that. It's highly dependent on economic growth, and it's much more GDP linked than the needs-based asset. It's more growth-oriented asset. Industrial has been an extremely strong sector, one of the strongest sectors of all these sectors because of the growth of distribution centers and data centers, and as well as manufacturing growth, surprisingly. So it has over a few months been slightly higher vacancies because it's just pretty easy to build these industrial flex buildings, just big empty lots. And there has been a lot of building recently. Although with lumber prices up, who knows? Retail is another commercial contract. And I want to emphasize the point of the contract because these asset classes, including office, the third one, it's highly the valuation and the cost, the revenue, all of it is tied together to essentially the value of the contract. And so when you buy any of these asset classes, it's all about, do you believe in this business? If it's a corporate bonded business, if it's triple net business, not triple, if it's a the triple A rating business, then you're going to get a much lower yield. Essentially, it's just buying corporate bond. But if it's a mom and pop business that has it's a single footprint locally and doesn't have anything else, it's high volatility. But if you know that they are good standing in the community, if it's a good barbershop that's been there for 30 years, maybe barbershop's not the best type of business in these days, but a community retail store that has a long track record, and you kind of know them, that could be a good investment because essentially they have less leveraging power than when you buy something that has a Starbucks, which generally trades at a 4 to 5 cap. 5 caps would be very hard. It doesn't matter what location. It's very, essentially buying a corporate bond. 7-Elevens are one of the lowest cap rates. Lower cap rates generally indicate lower risk and lower yield. And so retail is a wide spectrum. And some people think retail is dead. I think it's being reinvented. I think there's a wide spectrum of retail, and single tenant retail is one of the safest investments, especially when it comes with corporate bond, when it comes with a Panda Express or Jack in the Box or In-N-Out. And it's almost always triple net leases, although not always. And that's the same for all these three asset classes we talked about. Vacancy periods can be kind of low depending on the size of the lot, the infill, because it's much easier to infill a small a space than a much bigger. An industrial and office might be bigger. Big box retail like Kmart's and Sears have gone through this transformation. Now they're getting bought by Amazon as distribution centers. Malls are being bought by Amazon as distribution centers. So real estate is real estate. It can be repurposed, repackaged. Big box retail was also repackaged somewhat for cold storage and self storage. And depending on how many years of vaccines we need, we might need more cold storage. That's slightly a different asset class. Should look into that. So retail very much tied to the value of the contract, which will also present itself when you get loans on any of these things. It's the value of the contract is also very dependent on how long is the contract, how long is the lease. If it's only 2 years left in the lease, you're gonna pay a very low discount. It's gonna be mostly the property value, which has maybe it could be only half the value relative to the contract. And so something with a 10-year lease versus something with a 2-year lease, you could see a big difference in price. But if you know that that building or that tenant is going to renew, after those 2 years, you could have an inside advantage in asymmetric information when you're buying something. So a lot of things what I said also applies to office. Urban infill has generally been more challenging as the pandemic. People want to go to space, but there's still suburban offices. Office will still be a big category. But it generally has some same qualities of industrial and retail. When I think about these type of assets and the tenants, it's always a little bit easier from a management perspective to manage tenants that are professionals. Office generally has a most professional type of customers. Now you have all the way down to student housing and mobile home parks. So workforce multifamily. But of course, those generally potentially has more complexity in operations. So office generally has, if you can get a business that you believe in, they have long-term growth. Most businesses would rather rent than own their own property for tax reasons and for balance sheet reasons. So it's getting essentially a contract on something that you should probably believe in the tenants and the tenants' viability. And when you buy something like an office building or a retail shopping center or industrial, you should always ask for the company's P&L and the last 3 years. You're doing your own business check on them. So those are the contract types. And I'm going to go to the last category, operating businesses. It's really a mix between multifamily and a little bit of a niche of residential multifamily. It's still a needs-based business, but the big difference, especially for senior living, and the other one of hospitality, is it's very much about an operations layer. Senior living hotels can be poorly run and be exceptionally run. Location is much more a factor with hotels, but operations and operation excellence is much more a factor with senior living. Cost cutting is in HR. Because it's an operating business on top of real estate, it generally generates a lot of cash flow, especially if you're doing it right. There's a lot of great fundamental tailwinds of an aging population and silver anomaly for senior living. If you think about who the clients are, who the tenants are, the customers are for senior living, it's folks who are generally not income dependent. They're retired. They have a substantial retirement account, or they have they're on the last years, and they generally average residency is around 3 years. But it also has some challenges depending on the type of senior living, because it's a wide spectrum. Could be tied to Medicare and Medicaid, which is potentially higher regulation. There are other asset classes that other senior housing that are private pay. We'll be presenting on one this Thursday that is private pay, and it's assisted living and memory care. The other parts of senior living is independent living and skilled nursing. Hospitality, the last one I'll talk about, the one I have the least experience with. it's one of the highest potential yields. One of the things that when I was looking at hotel conversions is I could buy, one of those like garden style hotels, buy at a cap rate of 9%, and then convert it to multifamily and sell it at a cap rate of 5. It's like a really great opportunity to invest back in last year. Now things have gotten a little better. Occupancy is up, not to what it was last year, but it was around the high 20s in the worst of the pandemic, which is still surprising to me. Like, who's still traveling? Now it's around up to the high 50s, and I think it was at a high point, the year before, nearly around 60%. So traveling's back a little bit back. Hotel occupancy is on the rise. So potentially some of that value is a little bit off table. But I have less experience on this one.
And maybe this is a good point before you start moving into comparing and contrasting the asset classes. Let's take some questions. Is that okay?
Mm-hmm.
So an investor asks, for residential properties, I often look for them on Zillow or Redfin. What's the best way to find deals for commercial properties?
It's a challenge. Go to Josie Capital. It's a challenge. I think if you're looking for a site that is similar to Redfin and Zillow, go to loopnet.net or Crexy, and I'll type it in chat.
Why don't you focus on the answers? I'll type.
And it's not necessarily. I'm going to say it's not the best way to find deals for commercial properties, but it's the most comparable sites to a Zillow and Redfin because it's a marketplace site that shows you a lot of different commercial properties. But the challenge with these sites is it's generally what we consider, especially LoopNet, a graveyard for deals. If you're finding it on LoopNet, 20 people have passed on it, and it's, it doesn't mean you can't find a deal on LoopNet. It's just that you got to make a very lowball offer. You got to be very good at evaluating these properties. But it's a really great way to look at a lot of properties, look at a lot of offering memorandums, look at a lot of metrics and information. So, the best way to find deals is really to know a lot of brokers and get some of the early leads. That's, it's much more of an inside baseball game than going on Zillow and Redfin for residential.
Awesome. The next question, I think we're going to be talking about specific asset classes. An investor asks, talking about self-storage, are they in demand all across the country or in only certain urban areas?
I think self-storage is demand all across the country, even in suburban and rural areas. Surprisingly, one of the things that you still see is even in less densely populated areas, people still need storage, and people still need clean storage. And sometimes the storage is just easier and cheaper to then build a shed to hold stuff. So it's still going to be about supply and demand, how much availability you have versus a certain geographic area.
Awesome. Talking about student housing, an investor asks, how is or will student housing be impacted at tier 2 schools? Example, private university, liberal arts, not the professional engineering and medical schools. How do you think they will be affected?
I don't know, did I go to tier 2 school? It depends. That tier school, it's private university. It's no D1. That's a D1. I think the challenge with looking at these tier 1, tier 2 schools is that the pricing is typically priced into these things. So then you have to think about the long-term trend of the geographic location. Usually, universities are also clustered. So a University of Kansas, which is tier 1 school by definition, could be local to an art school that's nearby that also has housing needs. But these universities generally clustered. Don't really have a great answer to your question. I think the tier 2 schools and what's going to happen in learning in universities will be something I would monitor highly. But student housing can also be converted to regular multifamily. So it's not like you're tied to the type of clientele.
Okay. Talking about mobile home parks, I think it's a very generic question. What is the occupancy stats of mobile home parks, and is it decreasing?
I think overall, what I've seen in my research is that there was obviously a dip in occupancy in general across every asset class, but mobile home parks have had a long-term good trend. When you think about people moving down the economic ladder, they need to move down to more affordable housing types, and if they are so lucky to have a mobile home park nearby, which can be oftentimes 5 times less than a single family in the nearby vicinity and still have the same school districts for like a suburban infill mobile home park. I think that's why you see these mobile home parks very hard to get into. As a potential tenant, it might be very hard to get into because no one's going to leave. It's sort of like affordable housing. You don't want to leave a Section 8 housing or something that can get a big government discount. Mobile home parks don't really have the same thing, but it has essentially a very significant discount relative to.
I completely agree with you, Eng. For people living in California, if you've driven down the 99, CA 99 and seen mobile home parks on either side, they are actually at very good occupancy. And I personally have looked into a few of them. An investor asks about triple net leases. Does the tenant usually pay for any repairs with triple net leases?
The tenant pays for almost every repair, except for typically big CapEx expenses that it's more building wear and tear. But like any maintenance, the great thing about triple net lease is that any issues with water or plumbing or the lights, no one calls me. They're professional businesses. They want to get those things fixed. They're not going to wait for a landlord to fix it. And one thing that we do is also when there's snow or weather issues, we take out trash, but we pay for that. We have that amortized to the tenants, so they cover that as well.
So typically big CapEx things, like Eng said, change the roofing, completely repave the parking lot because it's shared between multiple tenants. That's what you would be worried about, but it's normally baked into the whole deal itself ahead of time.
Mm-hmm.
An investor asks, what classes have you invested in? I presume you mean Josie Capital or Eng. I think both are fair game. What classes have you invested in, Eng?
Me personally, I've been investing in a lot more than Josie because I have bigger risk tolerances sometimes than Josie. And I want to make sure that, so for me personally, I invest a lot in retail shopping centers. I've bought some really nice ones that have nice, like 7-8 cap with Dollar General as an anchor tenant. But they also have some volatility. And I don't necessarily love the volatility. I have single family houses that I owned from a long time ago. But I bought mostly multifamily, senior housing. I invested in self-storage. I invested in mobile home parks, but I sort of as an passive investor, but I haven't owned operated any of these.
Yeah, and I think it makes sense for you to have answered it as Eng as opposed to Josie Capital, because most of our investors can look at what our investments in Josie Capital have been on the portal once you've signed up to the portal. An investor asks, and I probably have to preface this for new investors, how would you categorize PEC as an asset class, or is it something else? PEC is one of the offerings on Josie Capital. PEC stands for Private Equity Credit. Consumer credit, private equity consumer credit. Now, keep in mind, investors, today we are talking about real estate asset classes. So PEC doesn't come under real estate asset class. Neither does TerraCell, our blockchain fund. Although there's a lot of real estate implications in that, those are not real estate asset classes. They are other private equity or passive income classes, but not real estate asset classes. I'm sorry, Eng, I answered that for you.
Yeah.
Next question is, typically, how much of your own capital do you need for these commercial investments?
It's a good question. I think that's very varied because if you some of the size of these investments could be as low as the price of a single family house. I've seen single tenant retail being as low as 400,000 and 500,000. And so I think from that perspective, it can be very accessible. A multifamily 8-unit you can find in some tertiary markets for as low as 300,000. I've seen a 42-unit building bought for less than $1 million. So it's very market dependent. In terms of capital, in terms of the full amount, with residential, you can get 5% leverage loans, which is amazing, FHA. But for commercial, it typically is 70 to 65, sometimes 80. So it really depends on a few things.
To all the investors, this question and the answer was actually very important. If you want to become solid investors in the commercial real estate space, what Eng just mentioned is very important. So when we share the recording, go back to this question. This is around the 45, 49-minute mark, and look at the numbers that he talked about. How much capital do you need is actually a very important question. And thank you to whoever asked that question. Eng, I know you have to proceed with the slides, but I would prefer taking the questions from the investors because some of them are actually very interesting. Okay. Sure. An investor asks, what's your take on platforms such as CrowdStreet for commercial investments?
I think platforms like CrowdStreet has really opened up accessibility to investors. And I really like when people can get exposed to great alternative investments that typically was not within the band of what was available. So I like CrowdStreet for its UI and its information. It's nevertheless still a platform, still a marketplace platform. So you still have to do your own due diligence for every one of these investments, but you get a lot of wide variety. And that's the same reason why I go to Crexi and LoopNet still, because I get wide variety. Doesn't mean I'm going to buy any of these things. It's just a really good research tool to see essentially what other investments look like or what these assets looks like.
So, and can I just throw in my 2 cents as an investor on CrowdStreet? A big fan of CrowdStreet, the platform, how easy they've made it. But as the number of deals in CrowdStreet has increased, we have to be very cognizant of the fact that it's a marketplace, right? Their job is to make sure they present the deals without any bias, either towards the sponsor or towards the investor, and they get a cut. So when the volume of deals increases on CrowdStreet, you have to be careful, which means maybe the CrowdStreet team, for the size it is, did not have enough time to vet out the deals. They are improving their process. So like Eng said, look at it as a marketplace, but vet out the deal on your own. That's your responsibility. Let's talk about the taxes later, because for the person who asked about, are you going to be talking about depreciation and tax benefits, opportunity zone investments? Just go to YouTube, type Josie Capital. We've done 2 specific webinars on tax benefits, and OZs. We have OZ investments at Josie itself. So please look at those 2 webinars, and we go into gory detail as far as that's concerned. Still, if you have time at the end of today, we'll answer any immediate questions that you have. Now we're going to a little bit of comparison, right? So let's take these questions and maybe you can answer them as part of your slides. An investor asks, what asset class offers the best tax advantage for an investor who is a primarily W-2 income investor?
I think that is unless you're doing a bunch of other things like real estate professional, the best tax advantage as a W-2 investor will essentially just be what's the best cash yield that essentially tax deferred. So then you probably just want the highest cash yield projects, which generally has higher risk. So that could be retail, that could be hotels, that could be whatnot, because you can take depreciation. Depreciation can be used across any of these asset classes. I think what is the best asset class to invest in personally, actively as a W-2 investor is probably the one that has the least amount of work involved if you're trying to still maintain your W-2 job. So consider that as well.
Awesome. An investor asks, are there any specific classes that you introduced today that are more friendly to a early or newbie investor? For example, which one should I start off with?
I think single family houses is very much about investing in appreciation and the market availability, but it's the most accessible. If you're looking at something like a triplex or quadplex, where I started, that's very accessible as well. And now you're looking at housing cash flow, although it still has characteristics of single family houses. Fiveplex to eightplex, very accessible in certain geographic locations. Harder to find, but very accessible. It's not that much more difficult to manage than a fourplex or a single family. Single family retail shopping centers, single retail shopping centers, single tenant retail shopping centers. It's easy. It's essentially just buying a bond. You buy something, you put leverage on it. It maybe has a 4.5 cap. You put a 3.5, cost of capital. Take a 1% spread on a 70% leverage amount. But your 30% gets you 4.5%. You're making 5-6% easily with rent escalators and depreciation benefits, tax deferrals, etc. It's a good it's a good bond. It's a good tax-free bond. It's a community bond. It's easy, but it's actually probably not too expensive to get into.
There are a few questions. So to all investors who've logged in, I know we're reaching the top of the hour. We will stay back to make sure we answer all the pending questions. But we are very mindful of your time. So in case you're going to be logging off, definitely look for the link to the webinar's recording that will follow up later today. That's one. The second thing is definitely from my side and from Josie Capital, we want to be very, very cognizant of the fact that a lot of our investors have family in India, friends in India. There's a lot happening out there in India. So we absolutely have everyone in our thoughts and our prayers. We hope that the situation becomes better there. Till then, hold tight and let's stay positive about how it is. We'll go ahead with all the questions, because I think some of these questions will sort of cover what you have in your slides. An investor asks, do you think it's a better strategy to have a wide variety of assets or to become an expert in just one or two types of assets? That's the first part. The second part is, how much should I aim for geographic diversity? So one is asset class diversity, the other is geographic diversity.
How much money do you have? If you have a lot of money, diversify. If you don't have that much money to invest, I think you got to make some risks. You take some bets. I think there's a lot of market correlation across the board, but there are still tertiary markets and primary markets. LA and SF has behaved very differently than Kansas City and Columbus. Different asset classes have behaved very differently. Industrial has behaved very differently than hospitality. But in general, real estate has a lot of similar correlations around impact from financing and capital markets. What I would suggest is, if you're investing across the board spectrum, like you're investing in stocks, look for an operator, a sponsor, an investment company like Josie that has multiple asset classes, and try to invest in as many as possible with as many geographic diversification as possible. You're taking their expertise and hopefully they're scaling in a manageable way. So that's something I would consider. Like, if I'm buying stocks, I'm not just buying one stock because I'm not owning and operating that business. I'm buying multiple stocks that I have no operational impact on, but I'm taking those multiple bets.
Thanks, Eng. An investor asks, how do you go about learning about these specific asset classes or even in specific geographies? How does one go about learning?
I think there's a lot of great reports from Marcus Millichas, CRB, big institutional commercial real estate stuff. Get on their mailing list to learn about different markets. It's really good to talk about to brokers, although everyone who's trying to sell you something will have their bent on it, as well as their bent on the specific asset class. My suggestion is, if you're looking at different markets, try to narrow and triangulate. There's a lot of great markets, especially in the Southeast and South. And I think, when you're looking at markets, always consider population growth, job growth, and crime decrease. Those three factors will allow fairly robust fundamentals to happen for real estate.
All right, thank you so much. We talked about a few asset classes today. Are there any restriction in investing my IRA money in these asset classes?
No. And there's no restrictions in tender exchanging as well, and any other real estate type of stuff. Because what it is generally is, is it an income producing property? Is it an income producing asset? And so investing in tender exchange or IRA, self-directed IRA, all these concepts are very spread across any real estate.
A few questions about Josie Capital itself. Let's club that together. But there's an interesting question here, and I think it's good for all investors to know. Are medical facilities another asset class? Medical facilities are also called as MOBs or medical office buildings. Are they another asset class? Yes, they are. Yes. If so, what are the pros and cons for that class? It's a specialized asset class. Pros and cons of medical office buildings is a question.
I would classify them in the office. An office really has, the big office and the small office, and it's a business, and medical office can be repurposed for many other things, but it typically stays medical office because of the heavy capex in it, and generally it has fairly resilient tenant base, so it's priced accordingly.
I'm just seeing what's the best way to move this around. Okay, let's start with this. What's the difference between investing in CrowdStreet and Josie Capital?
The difference is probably you're investing in, Josie Capital, investing with me, and I'm investing in every one of these investments. I'm typically the biggest investor on each of these investments. I consider them my investments, as in I'm putting money into it. I would buy these assets regardless of whether somebody comes in. I have been approached by platforms, marketplace platforms, to host my projects on their sites. I don't necessarily want to share a fee or a commission to CrowdStreet or to other things, because I think these assets are really good and very investable. And so I don't necessarily need to. So take that for what it is, why somebody might want to present on a CrowdStreet. And I think ultimately it's about, investing with somebody who you can grow it and can trust and have relatability with.
Yeah, but actually there is a very, very clear professional difference as well. By and large, CrowdStreet as of today is a marketplace, which means CrowdStreet might not invest in any of the deals that you see there, but they get a fee. And they're not lying about it. That is their primary gig. They also have managed funds, blended portfolios that you could put your money in and they would invest in some of these offerings. But by and large, they are a marketplace. Whereas Josie Capital is not a marketplace. It's a place where Josie Capital, are investing themselves and you are joining as a limited partner investor. That's a huge difference. Skin in the game is the one sentence to explain that. What are the three key things one should look for to choose a syndicator? I know you don't like that word, for investment. What should I look for in a syndicator, Eng?
I really think if they have skin in the game and the economic incentives are aligned, you're looking at sharing that risk, sharing that profit. In some cases, if you're prioritized, which is what I try to do with my investments, is you're getting preferential. I think ultimately everything resolves around money and monetary economic incentives. As somebody who studied economics, try to be in a position to have potential leverage on the economic side, but don't have to be in a position to have potential control, because you might mess that up. That doesn't do anything for you. Have economic leverage by making sure that you're in a preferential position, that you're in a shared position with a syndicator.
Thanks, Hank. Slightly longer question, but I think it's important. For commercial investments, what are the pros and cons of participating in a syndication, where there is a shorter time period of holding and reinvesting in another syndication versus going on your own and holding for a longer time period?
So typically when you look at a syndication on any asset, you're looking at a project level return, meaning that what if I bought that project myself, versus an investor level return. And that's something you should probably think about. it's not a very fair comparison because typically it is a 2-point comparison. You're looking at an 18% return versus a 20% return if you brought it yourself. But that also means that you have all the expertise and the capital scale and the economy scale and all the experience to manage it like that syndicator. So hopefully you're valuing that expertise in a fashion that provides some, value for you. Another part of, so in terms of why potentially syndicators want to have shorter exits, because they have investors who want shorter exits. You also are taking a lot of the tax benefits right up front. And so taking that and holding it for longer periods of time, you're not necessarily getting potentially more benefit. In fact, it's a diminishing return because you're getting less depreciation over time because you got so much in the first year from bonus depreciation.
And folks, we are at the top of the hour. So if you have to drop off, we absolutely understand. Thank you so much for joining us today, but we will continue and answer the rest of the questions. There are a couple of very interesting questions comparing and contrasting stock market and commercial real estate investment. I'm sure we have a few things to say about that. So let's hit that, right? An investor asks, when it comes to investing, at the end of it, it comes to return on investment. Of all the real estate projects and deals that I have heard of in the last 1 year, it's 12 to 15% per annum. Okay, that's what the investor says. Why should I consider this over investing in the stock market if one can manage to get 15+% per annum?
Good question. Good question. Let's say that you got equal returns. I still would gauge as real estate being more beneficial due to the tax advantages. But if you're valuing the passivity and the liquidity, then stock market has certain advantages. The bigger question is 15% sustainable in the long run? Over a long period of time, you can see there is a yield that is relatively comparable to the market on unlevered real estate. But once you lever it, it becomes a bigger factor. And so you're usually seeing for real estate investors, typically for really good ones or people who have just been in the industry for a while, typically 80% to 150% more than the market over a long period of time. I think we can all be biased by what's been happening in the last few months. And would I wish I had more Tesla stock? Sure. But I've done very well in real estate as well. Asset classes across the board are growing up because there are more capital out there. There's more cheap sources of capital, and wealth and capital always try to search for yield. And real estate has been a very sustainable and predictable source of yield.
Thanks, Hank. I have a 15-minute thought on this, but I'll hold it for another session. There's an interesting question when it comes to stock and real estate. An investor wants to know, Hank, what's your personal asset allocation between stock market and real estate as a passive investor? Stock market is not passive investment, but I think I understand the question. Between stocks and real estate, what's your asset allocation, Hank?
I think it's around 75 to 25%.
75 being?
Real estate.
75 real estate.
As a passive investor. And that's only because I've accumulated a lot of Apple stock and I have a bunch of other stock that's been doing really well. But in general, real estate, and I'm talking about as a passive investor, as an active investor, as somebody who owns real estate with Josie Capital, it's closer to 95 to 5%.
Got it. Yeah, I think that's a very good differentiation. I think the 75-25 is what we will say makes sense. An interesting question, and I think another investor also asked about 1031 limits, the 500K limit, but the general question is, there are talks in the government to eliminate 1031 exchanges. Mm-hmm. Assuming this goes through, how will this influence your investment decisions going forward? That is, are certain asset classes more attractive?
I think that's a good question. I think in a tax optimizer like me, who is carrying a lot of depreciation and a lot of losses year over year, and also making a lot of gains, I think I would be okay because I would find there's lots of other ways to minimize taxes than just using tender exchanges. Opportunity zones come to mind. But for overall strategy, I think elimination tender exchange will likely cause potentially less transactions to happen, less reinvestment in the asset itself, as people just hold on, because just like, why would I sell for $5 million when I have a $4.5 million tax bill? As long as it's making a little bit of yield, they wouldn't do it. I think how people would borrow more against those assets is equity. Capital, you can tax income and tax capital gains, but what happens generally is people just borrow more. People just don't sell. You probably see syndications like myself probably do more refinance, where instead of tender exchange and exit, we just refinance, and just be perpetual income generator.
Makes sense. And if I might add my 2 cents, right? My understanding of how the United States works is over time, you see that the rich put their money in commercial real estate. So even if one tax benefit is eliminated, you can be sure that within 2 years, they will bring another bill, another aspect of it where there'll be tax advantages. So tax advantage in real estate is not going to disappear. The second thing is tax is always on profit. So as long as you're making profit, be happy. If it comes to it that you have to pay a little bit of tax, that's okay. But you most probably won't, because the rich will rewrite the laws to make sure they don't pay. That's my opinion on that. Couple of interesting questions. What should we look for while choosing a self-directed IRA custodian for real estate investments? What services are must-have from these guys, and the price they should charge for it? I think, go ahead.
I don't really have a strong opinion on this. Josie Capital is partnering with Alto IRA, mostly because of its simplicity in UI and its low cost structure. I've seen cost structures as low as $100 a year to $1,000 plus a year. If it's a simple custodian of real estate investments, I would just want the lowest value or the lowest costs. So Alto IRA, Rocket Dollar, I know Dan was, there before, and there's a bunch of other ones. Look for some simple UI as well as low cost. There's lots of new ways that they're doing it through APIs that limits the paperwork, which means if you're using an older one, it's just generally you're gonna have more paperwork and probably a little bit higher cost. Older one as in older type of older company.
Thanks, Hank. An investor asks, typically in most of the projects, I've heard of 55% bonus depreciation. Maybe you can talk a little bit about that as well. This can account to $27.5K with an investment of $50K. Is there an AGI ceiling for one to take advantage of the whole 55%? I'm thinking of an AGI of 120K. Can't carry forward real estate losses. Am I right?
You can carry real estate losses, indefinitely. I carry a lot of real estate losses. If someone told me I can't carry real estate losses, I would stop accumulating. I would still accumulate real estate. There's a ceiling for it. I think there is, if you're not real estate professional, I think there's 125 to use at least 25 of it. But I don't know the latest tax one.
Got it. An investor asks, can you share the URL of these IRA custodians in the chat box? I don't have them because I'm not into IRA-based investments. And we can send it as part of the thank you email, right? Or if we have time at the end, we'll make sure we do it. There's one final question, and there's more afloat in. I think it's more specific to CrowdStreet, and it would be unfair on us to comment on that. The question I do want to read out to other investors: what percentage does CrowdStreet keep from a deal? That's the amount you will lose if one invests with CrowdStreet as opposed to investing directly with a syndicator such as Josie. Am I correct? Partly right? But see, this is very transparent. CrowdStreet absolutely announces that these are their platform fees, and they are baked into the closing costs, the deal costs. So it's not that they're cheating. Yeah, but this is a very, very small amount compared to the benefits that you get out of CrowdStreet as a platform. With Josie, you get the advantage of the knowledge and the focus that Ames brings to an investment. With CrowdStreet, it's the ease, the UI, the flair. So everything has its pros and cons. Would you agree with me?
Yeah, and I think when people focus a lot on the fees and the costs, that's fair, especially comparing it why you didn't more. I think ultimately you should still compete and realize this is a good deal. Did they buy it right? Are they have a good business plan? Because I don't really care what you make. I just care that I make a lot of money. That's essentially what investors should think about.
Got it. So we have wiped the questions clean. We have two options now. We call it quits, say thank you, everyone, or do you want to talk about comparing the asset classes quickly?
I'll compare the asset classes quickly because it's actually very short.
Okay, let's do that.
I know it's kind of a weird thing to just go back in the slides. I have like a bunch more slides, but I'm not going to go through the rest of it. Do I have a... Can you see my slides?
Yes, your slides are there. Go for it.
Comparing asset classes. Okay. So there's a bunch of other asset classes, subcategories in them, and this is the spectrum of yield. It's a good indicator of like what risk is and reward is. Red being a little bit higher yield, green being a little lower yield, lower risk. And so I think some of this is also predicated by location, suburban versus urban, with suburban being very good recently because people want to move away from crowds. I like this slide, even though it's a little blurry. The average cap rate of certain asset classes, and the more tradable the asset class, the more relatively perceived safety of the asset class, the more competition, the lower the cap rates. The lower the yield, the harder it is to make money, the lower the margin of room for error. So hospitality on the one side, apartment buildings on the other. Retail shopping center, a single tenant being like right next to it, and multi-tenant being a little bit more in the middle. And then if you actually look at property returns over the last 10 years, just different, looks at how things have been impacted. Industrial has been one of the most consistent ones over the last year, but as with anything, I believe that will be a little bit overbuilt. And these, when you're trying to buy industrial now, this is already priced in. And then if you look by REITs, which is not necessarily investing in real estate, the difference between investing in a REIT, investing in a private offering, a private investment, is that you have market liquidity, and market sentiment, which dictates these movements in prices a lot more than the valuation of the properties. But it's a good way to look at it and see how by sector, which ones have done pretty well. And then finally, the last slide. I think there's a really good way to think about short-term and long-term lease being one vector of, hey, self-storage is relatively short-term, though it can be long, but it's relatively easy to infill, meaning that the vacancy between two tenants is kind of short. Full service hotel, very short vacancy between the two tenants, less than a day sometimes. Industrial data centers, very long leases, hard to find. If you're building a data center, you kind of have to have a tenant in place before you even build it or you buy it. Same as medical offices. And then another vector, another way to think about it is it GDP linked? Is it tied to the economy, or is it untied to the economy? And for needs-based things like student housing, senior living, it's a bit less tied to the overall economy versus like hotels and office industrial, which is very much more about how's the economy doing, how's the economy within these sectors doing specifically. And it's very much GDP linked. So I think that's a really great way to think about these type of asset classes. And I'll leave it there because the rest is less potentially...
we could save it for another day, or probably what we could do is when we have our newsletters, we could probably add some of these. I have 4 more questions. I have a request to all the investors who are still on the call. If you have any questions, the next 2 minutes, just put the questions in, and after that, we'll freeze the questions. An investor asks me, Shiv, if possible, touch upon what's the process to invest with Josie for a project. Let me just make that quick, Eng, because I'm an investor. I typically can do a better job than you to tell how to invest in your offering. Josie, when they have an offering, will most probably do two things. They will inform you through an email saying we have an upcoming offering, and there would be a webinar just like this. There is a webinar, if I remember correctly, day after tomorrow, talking about a senior living offering, right, Eng?
Yep.
So this is where, dear investor, you can register for the Zoom webinar. Once in the webinar, Eng will be talking about the particular offering, what are the pros and pros. Obviously, there are no cons, I presume. And then what happens is you will log into the portal. You can create yourself an account in the portal, and you'll be able to go through the documents, the offering memorandum, the PPM, the pro forma, if you're interested in looking at it. Otherwise, reach out to Eng. So you can vet out the deal, talk to Eng or Ryan, and discuss the deal, and you'll arrive at how much you want to invest in that deal. Typically, there is a minimum. Then you would go ahead and sign the documents and fund the deal. And then by the time Josie has already purchased the property or is going to purchase it shortly, once that's done, you get an ownership certificate, and you will then follow it up with distributions and updates on the property. But step one, know about it through emails, attend the webinar, sign up for the portal, it's free, and then you'll be able to read more about the offering in terms of documentation, photographs, or demographic comparison analysis. That's how you typically do it. I hope I answered that to the best, right? Okay. Let's go through the questions very quickly. How does real estate private equity compare to REITs or REITs in terms of returns? It's not just returns, it's also in terms of the kind of returns, but go for it. Eh?
Yeah, so the returns, if you're holding private equity in real estate, you're getting pretty much the full benefit of it. And with REITs, you're getting a muted benefit, but you're also getting an additional benefit / impact of the liquidity and the market sentiment. If people sell multifamily REITs during these past, the first 3 months of the pandemic, that was probably a mistake because multifamily, generally stood up pretty well. So it's more correlated to market sentiment. It gives you much more liquidity. The dividends are generally lower. The dividends also have some tax implications. You also do not get depreciation pass-through. It's not a pass-through. It's a ownership of a stock, essentially. So you don't get the same tax advantages of direct ownership like in private equity or syndication.
Awesome. Thank you so much. 5 more questions. Before that, on the chat, an investor says this, and I think it's important to address, and we always talk about this. An investor says, thanks, Shiv. The very fact that you being one of the investors is talking on behalf of Josie goes a long way. Thank you for that comment, but there are 3 things that I want to be very clear about. As investors, we are joint partners, limited partners, but joint partners in each one of these offerings. So Josie's success and our success as investors are joint at the hip. Most of us are passive investors, but I'm not. I'm an active investor, which means I talk to Eng on a daily basis or on a weekly basis to talk about the deals that I've invested in. I visit the properties with him because I have a vested interest that Josie should be successful because my investment should be successful. So I am very closely working with Eng to make sure Eng doesn't fail, because Eng takes care of his success, but my job is to make sure that I look at the blind spots, and we have so many investors like me who Eng spends a lot of time with. So if you're interested, join the gang, be part of the process so that we can make this better every day. Thank you so much for that comment, though. Next question, Eng, you only have 30 seconds on this because I know this is interesting for you. Okay, don't spend too much time. Does Josie have any plan of data center or 5G related real estate offerings?
Data centers are very profitable. They have limited potential tenancy. One potential tenancy is Bitcoin mining. And we are actively evaluating potentially creating our own data center if it makes sense from a ownership perspective. I think data centers is generally, if I was investing in data center just as buying them actively, I think the cap rates would be too low I'm not in a position to just invest for capital preservation and sort of investing in these great trends, but not necessarily high yields. I'm still looking to get great yields in a relatively safe manner.
Thanks. Very interesting question. I think everybody should chime in on this. An investor asks, is there a way to talk to Josie's other existing investors to see what their experience has been? Right. Let me share my 2 cents, and Eng, you can go for it. Right. First thing, you would be talking to Eng or Ryan or one of these investment relations guys, right? Ask them who else you can talk to. Ask for a reference. But the problem is, you would think that they would obviously give reference only with their happy investors, right? So what did Eng try? And this is where we are very open to suggestions. Eng actually created a Slack channel for a bunch of his investors. He said, let's all discuss about it. It was open forum, but unfortunately, nobody participated. Is that correct, Eng?
Yeah.
So if there's anybody in this group who feels there is a very, very good way in which Josie investors can come together, see, what we don't want to happen is all these investors coming and slandering other syndications or just talking unwanted stuff. If there is a constructive way in which Josie investors can come together, and if you have an idea, just send an email to eng@josiecapital.com, and I think he'll definitely look at that. We'll talk about the Josie Slack channel for investors separately as well. I know a couple of investors are now asking about that. But we do. Eng, go for it. What do you think? Would you want your investors to get together and discuss?
Yeah, I think I love feedback. I think I thrive on feedback, and it's not feedback to just like pick what investments should I invest in. Although sometimes I will actively look for something like a SpaceX, like a Bitcoin mining, if it's something that I really believe in, and I also think there's investor appetite for. But I like feedback from an investor perspective, like how can we make the process easier, simpler, better. Because as somebody who worked in tech, and Shiv does as well, like we thrive off feedback and incremental improvements. So we've explored a Discord. I see some people are suggesting Telegram. I'd love to potentially explore some of those things.
Awesome. Here's an important question. I think this is a new investor when it comes to syndications. What can be the likely worst case scenario to invest in a syndication? What's the worst case scenario? That's question 1. What recourse do the investors have if a syndication is fraudulent, dishonest, or runs away with all the raised capital? And this is when you're going to go to the Cayman Islands next week. That's what the question is about.
Hey, I did not buy your ticket. Sorry, Shiv. I think,
but it is a serious question. So
yeah, the worst case scenario is you lose all your money. I think in general, that's generally the worst case scenario. Is there anything worse than that? Is there recourse to the investors beyond that from a liability perspective? No, because you're a limited liable partner. You're investing through an LLC. You don't have general partnership responsibilities or liability, or you're not on the loan as well. What recourses do you have if a syndication is fraudulent or dishonest? Definitely go to the SEC and complain to them. In general, it will just make it that syndicator cannot do that again, but it would be hard to, if they're running away, they probably have planned it out, I assume, to go with the money. So potentially, the way I think about it is, if you're hesitant about investing with a syndicator, any syndicator, doesn't have to be me, start small, get comfortable with them, get comfortable with the process, get comfortable with this whole thing of this whole real estate private equity world. And somebody's asking you for a lot and asking you to hurry up, just question that a little bit. So I think my experience is to hopefully, I'm a very analytical person. I like to test things out and try things out before I go bigger. Hopefully that's something that you guys can try as well.
Awesome. Eng, how are you feeling? Another 5 questions. Do you have the energy for it?
Sure.
Okay, let's do it. Let me see what's the most interesting thing here. Piggybacking of the 1031 exchanges potentially disappearing. Let's assume 1031 exchanges no longer exist in the future. Would this affect an investor's return in Josie's ongoing investments like Grand Royal or Hampton Manor?
Great question. All of our returns have been stated as non-tax adjusted, meaning I don't know what your tax rates are, so I can't tell you what your returns would have been. I can only tell you how much we would have given you based on the investment itself. So there's no impact on that side of things. What we promise you, what we expect projected for you guys, is what we'll deliver. In terms of investing in a tax advantage way indefinitely, that could be hampered, but I think there's ways to get around it. We'll definitely try to solve those. There's DSTs and other ways that are like 10 exchanges that potentially aren't being targeted. These things I explore all the time. I'm always trying to explore many different ways to shelter my own taxes personally, as well as my investors' taxes.
Okay. Let me take an easy one. Depreciation benefit is just tax deferral, but not tax forgiveness, right? If so, the only benefit is time value of deferred tax. That is correct. Unless you go into a 1031 exchange, then you're just deferring it in perpetuity. Am I correct?
Yeah, and then there's a step-up rule where if you pass the errors, it steps as a basis so that it's a complete elimination. Now, those two things are the ones that finance is trying to eliminate, but people have been trying to eliminate this for a while.
Got it. And this is a more immediate question. Maybe it will benefit others. An investor asks, do you have any recommended online tax filing software that handles OZ? It seems TurboTax doesn't handle OZ. Very quickly, see, TurboTax handles opportunity zone. The problem is just that Form 8997. That is not made into an online form yet. There's still debate out there if you can just send the 8997 independently. I know of no online tax filing software that handles 8997 electronically. Eng, what about you?
I don't either.
Yeah, so join the gang. It's good that you're stepping up and investing in something big. When TurboTax doesn't have support for something that you're doing, it means you've come to the big league. But the sad news is 8997 is still not online. It's been 3 years in the making.
Javier says Tax Act does handle OZ forms.
Tax Act does handle OZ forms is what Javier is saying. I hope it handles 8997. Javier, if you happen to know that, just answer in the chat that if it handles 8997. So to all the investors, especially the one who asked that question, maybe you should try Tax Act. Apparently it handles OZ forms, and yes, it handles 8997. That's awesome. If nothing, we all learned one big thing. Thank you so much, Javier. Right. And a question for you, where do you classify the Airbnb sector and its comparative returns?
I think that's a mix between multifamily, residential, and hospitality. It's hospitality-like returns. If you're doing Airbnb arbitrage, that's just a business, operating business. It's not real estate. It's real estate as rental income on real estate. But if you're investing and doing short-term returns, that's essentially generating a higher potential yield on an investment that trades at a lower yield. I think that's a really great way. If you can buy something that has a perceived value and increase the value by doing Airbnb or developing on it or getting new tenants, all those things give you a little bit of arbitrage and asymmetric return benefit.
Awesome. Javier does say that if you use Tax Act, there are other pain points like having to manually add the stock transactions, which is importing from the brokerage. But weigh the pros and cons. Why don't you give Tax Act? I think I'll give it a try just as a test run to see if it's true so that I can report back to the community. We are down to the last two questions. The third is just an observation. How do you choose between two projects if both of them are yielding 12 to 15%?
How do you choose between projects? Is it both yielding 12? I think I think about what's scalable and what's maintainable, manageable. So if I can share resources across the asset with another asset that I have, then it's much more scalable. If it's something that, if I'm typically buying something with the notion that I'm buying 10 more of these things because I gain better economies of scale, that I gain better exit scaling as well. If you're investing by yourself, then it'd be harder to.
Yeah, but I think the question is more from an investor, right? I'm looking at two deals. Both of them are offering 12 to 15%. How do I make a difference? What should I choose? I think that's what the investor is asking. I hope I'm right with that.
Yeah. Well, if the asset classes are similar, then you got to think about other variables, right? What's the term? Is it 3 years? Is it 5 years? Is it 7 years? Which one do you prefer? And if you look at two Tozy investments and you like both of them and they're yielding the same, ask us to split your investment across both. We're happy to accommodate more diversification for you guys.
As an investor, I can answer that in a slightly different way. It doesn't matter if that yield is 12 to 15% or 6%. I would go with the 6% over the 12% if the 6% is being sponsored by somebody who I intrinsically trust. Everything is about the energy, the ability of the sponsor. I think that is number one. Given if that it's the similar kind of sponsors and both of them are 12 to 15%, you can spread them, asset classes, geographic diversity. If one is in the Midwest, go one for the Southeast. So many different aspects in which you can actually slice and dice the investment. We have the Slack channel for investors. It's slightly dormant. Why don't you just message us, right? Once you get the thank you email, respond to that saying, what would you like us to do in terms of what kind of community, line, clubhouse? Yeah, we are open with everything, open to everything, but it should be useful. It should not just become a wasted time effort. So we'll see what we can do to get the investors together. How about, yeah, this is something that Eng has always wanted to do is how about Tozy facilitating investor network, virtual networks with breakout room sessions? You wanted to do that all the time, right?
Yep.
Tell us what you think about it. Do you want to have a breakout session with your fellow investors where you can powwow and talk about investments? I mean, even hold Tozy accountable, saying, hey guys, these 3 investments, we were not super happy with your format of your newsletter. You could do something different. If that's the forum that you want, just let us know. If we have more than 15 people who respond to the thank you email saying that we want to get together, we'll somehow make it happen. Is that a commitment from us, Eng?
Sounds good.
Yeah, I think the Tozy Capital team is also there online. So guys, that's for you. Everybody who is listening, Tozy Capital team, if more than 15 people come in and say, we want to have a group, we will help facilitate that group. So with that, we seem to be at the end. Let me see. Eng, why don't you do your closing remarks? I'll look at the chat window to see if there is anything else of significance, and then I'll make my closing remarks.
I really appreciate everybody staying till 35, an hour 35. That's a lot of endurance by you guys. I'm going to try to do a lot more of these really, hopefully informative webinars, bring my own personal experience into it, and try to, help enlighten you guys. I think when you compare asset classes, it's something that I would want to say it's still all very subjective to how you invest, how you acquire the deal, right? I think real estate just in general has a lot of innate benefits, leverage, tax advantages that if you're comparing asset classes, I think you should just invest in something, invest in an asset class. And that's high. Yeah, I think when you think about investing in real estate, if you haven't invested already, I would highly recommend you start either through actively or through Tozy.
Awesome. Thanks, Eng. Thank you so much for your time, for your patience. I enjoyed it as always. Love talking to investors, hearing them. Love your answers as well. You just call it as you see it, and that's what I like about how Tozy webinars are. So thank you so much for that. An investor has a last second question. Where can I read about Tozy's track record for the last 3 years? Please email Eng or investors at Tozy Capital. Ask them about their previous investments. Get your access to the investor portal login where you can see the closed investments, and they will be self-explanatory, but definitely reach out to Tozy Capital. With that, we are calling it an evening. Thank you so much for people who are there on the East Coast. I think it's 10:35, 10:40. Thank you so much, everyone. As always, the energy, the goodwill that we bring to this webinar is completely based on the questions, your participation. 100+ people participated today. So everybody at Josie Capital who made this happen feels happy when 100 plus people participate. So thank you so much for your time. You will have a link to the recording of this webinar as part of the thank you email later tonight in a few hours once the recording is ready. Thanks, Eng, for your time as always. And a quick pitch, coming Thursday, 2 days from now, will be a webinar where you'll be talking about your next offering. Is that a senior living offering?
Yes, senior living.
Okay, it's a senior living offering. Be there. Thank you so much, everyone. If we did not get to your questions, I'm very, very sorry. Just shoot across a question to Josie Capital and they take care of that. With that, we are done. Thank you so much, guys.
Okay, have a good night. Bye.
Good night.